Hello, everyone. My name is Ken Leon, Director of Equity Research with CFRA, and I would like to welcome you to today's webinar on investing in the Canadian commodity climate. Joining me today are Lindsay Bell, CFRA Investment Strategist, and our two senior analysts, Stuart Glickman, who covers energy, and Matt Miller, who covers materials. On slide 3, our agenda today will be a brief discussion about CFRA and then moving into our program on the Canadian equity market and the specific focus on the energy and materials outlook. Let's talk about CFRA. So on slide 5, our history covers more than 90 years of growth as an independent research business. Today, we're one of the world's largest independent research firms. CFRA today was created back in 1994, led with great expertise in risk metrics, forensic accounting, legal edge. In October 2016, acquired from S&P the fundamental research and funds business. So today, we have the ability to offer quality and scale on a global basis. On slide 6 is a very busy slide, but one that showcases CFRA's integrated solutions. It's the ability to take data, relationships, and analytics, and it's the expertise of our 75 global analysts to curate this data to find new opportunities, patterns, and risk as it relates to identifying industry themes and companies for getting great performance out of our stock picking. We have the ability, and we have in our publications, deep dives on both industry and companies. And we also provide research and insights across all the sectors, and not only equity research, but ETF and fund research as well. The engine of our proprietary methodology on slide 7 speaks to both our top-down and bottom-up approach. Top-down is market commentary, soon to hear from Lindsay Bell and also Sam Stovall. We also partner between the strategists and the analysts to have sector opinions. And Todd Rosenbluth heads up our ETF and fund research. Our company research is really the foundation for fundamental research, covering 1,500 global companies, and these are analyst-driven recommendations. You also have on Market Scope Advisor our model portfolios, and also commentary related to both strategy and industries. And every week we are publishing differentiated ideas and something we call thematic research on both the forensic accounting and also fundamental research side. Most importantly, here on slide 8 is why CFRA? It's independence. We invest 100% of our resources across the entire firm, focused just on research. CFRA does not manage money or make trades. Many of the independent investment research providers claim to be free of conflicts, but they're not. One last advertisement is we launched the TSX 60 coverage last month. And to go through the TSX 60 from a strategy perspective, let me turn it over to Lindsay.
Thank you, Ken. We'll dive right on in on slide 10 here. This is taking the Canadian region, the Canadian market at a glance, and no better way to do that than really start with GDP growth of the country. We're looking for 1.4% growth in 2019. That is a reduction from 1.8% in 2018, but we expect a rebound to occur in 2020 to close to 2%. 1.9% is the estimate that Action Economics has. The rebound is going to occur for a couple different reasons. One is as the country transitions its economy to be less reliant on natural resources and expand into other areas like cannabis and clean energy and AI. But also the rebound will occur because they'll continue to cycle a slowdown in some of the key industries, energy being one, which Stu Glickman is going to discuss in detail what has happened there in the back half of last year and bled into the beginning of this year. Now, my second bullet point here talks about U.S. GDP exceeding 2% in the next 2 years. And this is important because the U.S. market is key for Canada's success. They export 75% of their goods to the U.S., so a strong, healthy U.S. economy is important to them. Now, the main overhang, though, for the global markets in general really has been trade. And most what comes to mind first and foremost when we talk about trade really is the China-U.S. tensions that have been in the market for over a year. But when we think about Canada, there's more to it. Of course, that will have an impact, and it is one of the major risks for the Canadian market as well as the globe, as I mentioned in my last bullet point here. But also when you think about the Canadian market, you have to think about steel and aluminum. These tariffs that the Trump administration had put into place some time ago were recently removed on May 17th. So that kind of alleviates some pressure for that industry, but it also is a political positive for the country as Canada, Mexico, and the U.S. together all work towards progressing their NAFTA 2.0 agreement, which is called the USMCA, the U.S.-Mexico-Canada agreement now, as renamed by President Trump. What hasn't gotten a lot of press is Mexico and Canada are both already in the process of ratifying this agreement. All three countries have to ratify it through their legislative branches. But Trump started the process here in the U.S. You see a lot of news about how difficult it's going to be for this to pass through the Democratic House. But he sent a draft statement to Congress to kind of kick off the process of that ratification process. It will probably take some time to get through, but it's one uncertainty that's moving forward and eventually will be removed from the market. The Bank of Canada, just like the U.S. and the Federal Reserve, the Federal Reserve in the U.S. and the ECB, which we heard from this week, the Bank of Canada is also easing monetary policy. They've been on hold since October of 2018. The bank increased rates 5 times, so their interest rate right now is at 1.75%. And the bank has raised some concerns, especially about global trade tensions. But also in recent commentary, they said they're going to also remain data dependent and be especially attentive to developments in the housing, spending, oil markets, as well as trade. So their next meeting isn't until July 10th, but we would expect that they would, take notes from the ECB and the Fed and stand ready to become more accommodative if necessary. Now, the energy market obviously is a huge driver of economic growth in Canada, and so the price of oil is very important to them. Now, a lot of analysts, and Stuart's really going to get into this in detail, look at the differential in price between U.S. and Canadian oil prices. And there has been a gap that has widened between those prices in recent time, and that has a lot to do with some regulation, some pipelines that haven't been, the development of pipelines to transport oil has been a little bit behind schedule and causing a slowdown in production there. And so because of that, the differential in the prices had widened. There has been some new legislation that is trying to address these issues. So in recent months, we've seen that close back to more normal levels, but Stuart will get into why he thinks that is going to once again expand and weigh and put pressure on the economy there. Another pressure point for the Canadian economy is household indebtedness. This as financial conditions have tightened for households, so that's one area to watch because the consumer, obviously, like most economies, like our economy, is very important up there. So let's just take a look at the market on the next slide. This is a 5-year chart comparing the S&P 500 performance versus the TSX Composite Index. That's a little bit of a broader index of the TSX 60. It's significantly underperformed. You can see the blue line, and really the outperformance in the S&P 500 began in late 2016 with the presidential election when President Trump was elected to office. His policy on tax reform was really brought to the forefront, and positive expectations from that to help support corporate earnings growth really lit a fire under the market too. But taking a closer look, the differential isn't so wide. On this next slide, you see just the one-year chart comparing the two indices. And you'll see that the correlation between the two markets in the last year have gotten much tighter. The S&P 500 hasn't exactly done very much. Neither has the TSX over the course of the last 12 months. And there's an 85% correlation. You'll see, though, on the right-hand side of the chart, the S&P 500 starting to take off there on really trade hopes and obviously the Fed movement helping to fuel that fire. So that's a little bit of a differential between the two markets. Looking at the next slide, this just puts it into another perspective, compares the two markets. This is the relative strength of the TSX composite versus the S&P 500. So it's the TSX divided by the S&P 500, and you'll see on the right-hand side that the TSX has been pretty weak versus the S&P 500 for a number of years, since 2012. Again, a little bit of a bounce off of the standard deviation line there in the last couple years, but still strength has been really weak. So why is that? Let's look at the next slide, slide 14. Sector breakdown. This is a huge reason for the differential in performances from these two markets that are, neighboring markets and very close to each other, with Canada really reliant on the U.S. The reason the stock markets have performed differently is the sector breakdown. You'll see financials is the largest sector within the TSX. Then you've got energy, industrials, materials. Those are the top four sectors. And the difference here really is, I always like to look at energy again because it's a big economic driver in Canada, 17% of the TSX index. It's only 5% of the S&P 500. So it has 3 times more exposure to the TSX market than it does in the U.S. Industrials, 9% of the S&P 500 versus 11% here. Materials is another big outlier, very small sector within the S&P 500 at 3%, but it's 10% of the index, of the TSX index. And so the S&P 500's outperformance really can be attributed to its exposure to the technology sector. It's almost 22% of the S&P 500 market cap. Technology obviously has a lot of momentum behind it, especially in the last couple of years. It's helped drive the S&P 500 higher. It's been a leading sector there, while it's only 5% of the TSX. So they've kind of missed out on the upside in tech, and it hasn't been able to support this region. Turning to the next slide, this looks at those sectors' performances. Financials and materials, 2 of the 4 largest sectors, they've underperformed the TSX on a year-to-date basis, but industrial and energy has done better. One area I like to point out is materials. If you look at the year-to-date performance, up 1.2%, it's the weakest in the index on a year-to-date basis. If you compare that to the U.S. market, you've seen the materials sector in the U.S. market, while it's not as much of a driver of the overall index, it's up 13% year-to-date. And the difference is that in that, which Matt is going to go into a lot of detail about, is just the breakdown of the materials sector here versus Canada. In Canada, you have metals and mining companies really driving and accounting for the majority of that sector. But in the U.S., it's the chemical companies that are the key drivers and represent the majority of the sector and have been driving growth there on a year-to-date basis. Now, if you look at earnings growth for the TSX versus the S&P 500, we're looking for a little bit better growth up there at 4.5% versus 2.3% for the S&P 500. However, both those numbers are likely to come down given trade weakness around the globe. But anyway, the point is that there's a little bit better growth in Canada. So from a valuation perspective, what does all this mean? Looking at slide 16, this is the relative valuation of the TSX versus the S&P 500, so dividing the two PEs by each other. Again, it looks kind of like the relative strength chart. You see it's to the bottom and left-hand side of the chart right now, pretty weak on a valuation perspective relative to the S&P 500. It's trading more than one standard deviation below its historical average. And that's really a level that hasn't been seen many times in the past few decades, indicating there might be an opportunity here. Turning to my final slide here, slide 17, the TSX trades at 14.2 times on a forward PE basis. It's a 5.5% discount to its own historical average. It's one of very few regions around the world that trades at a discount to its historical average at this point in time. The only other part of the world that you can find a discount in right now is Asia, and that's partially because of the weakness that they've seen there from the trade pressures between China and the U.S. So the TSX is a much more high quality market that isn't as directly exposed to the China and U.S. trade spat. So it seems like Canada could be an area where you can find value in a market where it's very hard to find value, where many different regions are trading at premiums to their historical average. Now, with that, I'll pass it over to Stuart to dig really into the energy sector.
Thank you, Lindsay. So let's jump into it. On Canadian energy, we're going to get into it on slide 19. So when we talk about Canadian energy, what we're really talking about is Western Canada, both in terms of crude oil as well as natural gas. Two provinces, Alberta and Saskatchewan, mostly Alberta, comprise about 92% of all crude oil production in Canada. Two other Western provinces, Alberta and British Columbia, collectively have 97% of all Canadian natural gas production. So those three Western provinces are really, that's what's driving the bus for Canadian energy. Now on slide 20, I want to focus first on the left-hand side of the slide. The bigger Canadian energy producers, yes, they produce both crude oil as well as natural gas, but really it's a focus on crude oil. The blue bars on the left show you for the five biggest Canadian producers, liquids production in terms of barrels of oil equivalent per day in 2018. The much smaller orange bars show you how much production they're getting from the natural gas side of the ledger. And so it's clear that liquids is really the biggest component of overall production for all of these companies. The scatter plot on the right-hand side of the page shows you a comparison of that same level of production in 2018, but compared against the percentage of all of their production that comes from Western Canada. And in every case, these names are getting at least 75% of their production from Western Canada, and in some cases closer to 100%. So, if you're thinking about, well, what are the fortunes going to be like for these big Canadian producers, you really need to focus first and foremost on Western Canadian crude oil. Now, we move on to slide 21. This is looking at the different flavors of crude oil that Canada produces. Collectively, close to 5 million barrels a day in 2018. The biggest share of that is what's called heavy crude. This is the very thick, moves like molasses kind of crude oil that takes a little extra attention to get it to flow properly in a pipeline. Synthetic crude is a process where you take some what's called bitumen and then you upgrade it into a very light crude. That's the orange bar, second largest category. Then you have your typical light crude, and then you have your extremely light, what's called condensate. But again, it's the heavy crude that's the largest single component of Canadian crude production. Slide 22. Lindsay talked or alluded to this earlier about the Canadian heavy oil discount. So let's start on the left-hand side of the page. This is a line chart showing two different lines. WTI is the orange bar, West Texas Intermediate. The blue bar is the Canadian benchmark, WCS, which stands for Western Canada Select. And as you can see, over time, the orange bar is typically higher than the blue one, so WTI trades at a bit of a premium, or conversely, WCS trades at a discount. The right-hand side of the page shows you how much that discount has ebbed and has flowed back and forth over time. Most of the time, it's been in a roughly $10 to $20 range discount, We have seen periods in the past where it's really widened out considerably, notably in late 2018 when that discount widened to almost $50 a barrel. What that meant in practical terms is that the producers were effectively giving away the crude oil for free, which is why the Premier of Alberta stepped in and said, okay, we're not going to do this anymore. I'm going to institute production curtailments so that we can get this industry back on track. And that helped. But I think for a variety of reasons, that discount is probably going to widen out in 2020. One thing that I should mention up front is that this discount that WCS has to WTI is really a function of two different factors. One I'll call kind of natural factors, and the other one which I'll call artificial. The natural factors are Western Canadian crude is simply heavier and contains more sulfur than U.S. crude does. And because of that, refineries have to spend more time and effort to remove those impurities out of the crude oil and turn that into usable products that you and I can buy at the pump. And that's I think a major reason why the discount has always persisted. The artificial ones, the ones that I think have a chance to change over time, for better or for worse, are really market access factors. So when midstream pipeline space is completely congested, what ends up happening is you have too many sellers of crude oil chasing too little capacity to get it out of the region, and those spreads widen out considerably. Now on slide 23, I wanted to talk a little bit about the major differences between U.S. and Canadian oil and gas development. The most important part here is the first line, the growth vehicle. In the USA, when we talk about oil and gas development, we're really talking about shale oil. This is, these are the very brittle, very horizontal, thin layers of brittle rock that oil and gas deposits are trapped within. And that's what led to the development of fracking, to try to allow those oil and gas molecules to escape. In Canada, it's a very different model. You're talking about oil sands development, sometimes mining operations, sometimes steam-assisted operations. And those are much larger projects, much more expensive projects. Each of these kinds of projects develop different kinds of crude oil as well. U.S. shale tends to produce a light sweet variety of crude, which tends to sell for higher prices. Canadian crude is relatively heavier, relatively more sour, meaning it has more sulfur in it. And as a result, as I mentioned, that tends to trade at a bigger discount. The CapEx needs for these kinds of projects are very different. U.S. projects, CapEx needs are very low. The time to first production on new projects in the U.S. can be done in a matter of months. Canada, by contrast, the CapEx needs even for a brownfield oil sands project, but certainly for a greenfield one, very high CapEx needs. The time to get the first production is measured in years, not months. That means that you have to have, if you're going to be playing in the Canadian oil market, you really need deep pockets to do it. The first year decline rate, and what this refers to is sort of the geological feature that every year an existing well is going to produce a little bit less than it did the year before. In the U.S., shale oil plays tend to decline very quickly. So you might get, for example, 40% less production next year than you did this year. In Canada, by contrast, this is a plus for the Canadian oil market. The decline rate in Canada is very low. If you bring a new well to fruition last year, this year it might produce maybe 2 or 3% less. The hard part is just getting to first production in the first place. And then lastly, midstream access. I would say that in both the U.S. as well as Canada, midstream access is fairly constrained, but I would say that the outlook in the U.S. is a little easier, a little better than it is in Canada, where I would contend it's still more trouble. Something to be aware of when it comes to production growth estimates. The blue bars on the left reflect consensus expectations of volume growth by the big Canadian oil producers, 2017 up to 2021, and that shows a CAGR of about 8% per year. In our opinion, that might be a little aggressive, because if you look at all of Western Canada, that CAGR is less than half of that at only 3.9%. It's very difficult to reconcile those two sets of numbers when those big Canadian producers represent about half of all of Western Canada. If anything, I think that the consensus estimates that are being ascribed to the big Canadian producers might be a little bit too high. It's important now to talk about an industry threat called IMO 2020. IMO stands for International Maritime Organization. These are new regulations that take effect on January 1st. It applies to any vessel that sails on the ocean waters. And really what it matters to is vessels such as petroleum tankers or cruise ships, which use right now, which is what's called high sulfur fuel oil. The new regulations are going to slash the allowable sulfur content to just 0.5% from current 3.5%. That should have a relatively strong impact on Canadian crude, because Western Canadian crude, as I mentioned earlier, is what's called heavy sour. Sour means that it has a lot of sulfur in it. And so as a result, heavy crude is going to likely be priced at a discount because of all the work that's going to have to go into it to remove that sulfur out of the crude. I have a feeling that what's going to happen is that IMO 2020 is going to boost refiner margins, but it is going to do so at the expense of producers. That differential between light and heavy crude should widen, and the strongest impact is going to be on Canadian producers that don't have their own integrated refining assets or perhaps don't have enough of it. Let's shift gears a little bit on slide 26 to the midstream expansion issues. Delayed and canceled projects are meaningfully large in energy. This is actually, because of some news that developed last night, this just sort of highlights the fact that news is always changing in energy markets. So the line item listed here is TMX, Trans Mountain Expansion. Just got yesterday's federal go-ahead from the Canadian government. So that extra 590,000 barrels is now again in play. I would argue that it's far from complete. Even if they broke ground today on it, you're probably talking about 2.5 to 3 years of construction time before it actually is operational. And that doesn't even take into account the problem that you still need provincial go-ahead from the province of British Columbia, which is not in favor of oil and gas projects. But collectively, about 3.4 million barrels a day of pipeline capacity that has been on the drawing board and is either delayed or canceled. And that's meaningful in this industry. Slide 27 is a graphical representation of what we just talked about. So the line chart shows you Western Canadian crude production estimated for 2019 through 2021. Around 4.5 million barrels this year of total production, moving up to around 5 million barrels per day. Existing pipelines only account for around 4 million barrels a day today. And as you can see, that gap in 2019 between the line chart and the blue bar indicates how much extra crude has to get moved by rail or by truck because you don't have the pipeline capacity to do it. If you took all those delayed crude pipelines, as well as the ones that we listed as canceled, and got those into fruition, the midstream access problems would disappear. Part of that West WCS differential would disappear. And so there's an awful lot of reasons why the industry is in favor of more pipeline capacity. But for a number of reasons, starting on slide 28, it's a systemic problem. So why are there these challenges? The biggest issue is that you simply have different stakeholders outside of Alberta. British Columbia is Alberta's neighbor to the west. British Columbia is unwilling to risk its tourism industry by running new oil and gas pipelines into the province. So Northern Gateway, Trans Mountain Expansion have had a host of delays run by BC regulators and BC politicians. You also have First Nations tribes that are unwilling to cede territory for compensation. In some cases, there have been political concerns over water quality, which is what is currently bedeviling the Line 3 replacement in Minnesota. And then lastly, you have issues of greenhouse gas emissions, which is what derailed the Energy East pipeline that was supposed to move crude out to the East Coast. Environmental lobbies have been very effective of late. They know that delays are expensive because time is money. And then in addition to that, you also have sort of fundamental issues, such as now that we're just slightly ahead of IMO 2020, what happens to heavy oil price differentials? Are you willing to undertake a brand new pipeline project if that differential gets so wide that customers don't need it anymore? Slide 29 is a look at broad performance level kind of analysis. So the blue bars represent the TSX capped energy index, its outperformance relative to the TSX overall. And the orange bars represent the S&P 500 energy outperformance relative to the S&P 500 overall. This is not the greatest advertisement for energy investing because in 5 of the last 6 years, including this year, energy has underperformed relative to those broader indices. But what I think is notable is that they seem to be moving together in the same years. So I don't think an argument can be made that, well, if Canadian energy is a poor investment decision at this point, in general, we'll just go with a broad-based U.S. ETF. I think if Canada tends to underperform this year, the U.S. as a whole will as well, and it speaks to the need to look for individual stock selection to really try to find potential winners. Now, moving on to those potential winners as well as potential losers, our investment views on Canadian energy. We think there are major headwinds for Canadian oils that are going to remain. Our price deck expectations for 2019 and 2020 are somewhat mediocre. IMO 2020 really has the potential to ruin realized pricing. Midstream access really still has a fair amount of entrenched opposition. Among the producers, we would suggest focusing on names that don't depend on export markets. And among midstream names, we would suggest focusing on names that don't depend on higher profile crude oil growth catalysts. Moving on to slide 31, the only name among the 5 major Canadian producers that we discussed here that we have a positive opinion on is Suncor Energy, ticker SU. We have a 4 stars or buy opinion on them. Suncor has the advantage that they have their own integrated business model. So quite honestly, it doesn't matter what happens to WCS price differentials because they can simply sell all of their product to their own refineries anyway. Imperial Oil and Husky Energy, we have neutral opinion or 3 stars. Imperial Oil has challenges with utilization and reliability. Husky actually has a couple of advantages. They have the lowest exposure to Western Canada among the names we discussed. The U.S. Midwest refinery exposure should benefit, but from a valuation perspective, we think it's about fairly valued. Now moving on to slide 32, the last 2 of the big 5 names we have negative opinions on, Cenovus Energy and Canadian Natural. In Cenovus's case, we don't think they have sufficient refining assets to insulate against Western Canadian select price weakness. In Canadian Natural's case, they have there's a lack of downstream access. That's a headwind, and whatever they have that is not oil sands, it's pretty low margin as well. So we have a strong sell on Canadian Natural. We're a little bit more sanguine on Canadian midstream. Both Inter Pipeline and Pembina Pipeline, we have 4 stars opinions. Both of those should have decent growth from exports to Asia. In Inter Pipeline's case, NGL exports, and in Pembina's case, LPG exports. And that concludes my portion of the review on energy, and I'm going to turn it back to Ken.
Okay, let me just jump in here and say that you may submit questions using the GoToWebinar panel. We'll do our very best to answer many of the questions that are coming in. So with that, let me turn it over to Matt Miller.
Yeah, thanks, Ken. Let's now turn our attention to the materials sector. As Lindsay had highlighted, materials is the 4th largest sector in the S&P TSX Composite Index at just over 10% of market cap. And this is contrasted to the S&P 500 at only 3%. What's pretty interesting about the TSX 60 is the large cap index in Canada. It has a 4.3% exposure to precious metals. And many financial advisors suggest having around 5% of portfolio in precious metals to hedge portfolio risk. So it's interesting that buying an ETF that tracks the TSX 60 almost achieves this goal. The S&P 500, in contrast, only has 1 precious metal name in the index. That's Newmont Gold Corp, which has an immaterial weight to the S&P 500 at only 0.1%. Canada is the 4th largest gold producing country at around 5.4% of total global production. However, mining is very different than energy in the fact that all the miners in Canada are really global businesses and operating in several regions. It's important to note that nearly a quarter of the world's mined gold comes from Africa, home to many unfriendly mining jurisdictions where resource nationalization has been and becoming increasingly a headwind. So it's very important to assess a company's geopolitical risk before investing in a particular miner. On the next slide, slide 36, we can see the recent history of precious metals. Gold is obviously the most newsworthy precious metal, as it has rallied to a 5-year high, I believe 6-year high as of today. So investors, though, are not limited to gold. Other precious metals include silver, platinum, and palladium, and you can see the strong run-up that palladium has had. Palladium is used extensively as a catalyst for auto manufacturers and has really seen the strongest run as of late. It peaked at around $1,600 per ounce before it sold off a little bit and is now trading close to the price of gold. When you compare precious metals, gold is the metal that has the least amount of utility, industrial utility. And so gold is mostly used in jewelry and coins and bars as investments. And on the next slide, we're going to take a look at the bull and bear case for gold. The most common point, and one very applicable to news that we received from the Fed yesterday from gold bears that they'll make, is that the opportunity cost versus an interest-bearing security is huge. And so as gold really doesn't generate any cash. However, what has been proven time and time again is that gold's purchasing power is retained throughout time. And so that's really attractive as a hedge against inflation. It's also a major hedge against market uncertainty. So CFRA, we do have a positive fundamental outlook on gold, given the enhanced level of uncertainty, a dovish Fed, also a very maturing economic cycle. We think gold prices are poised to continue to increase and could be trading above $1,450 per ounce towards the end of this year. Whereas until yesterday's Fed statement, gold really struggled to break above the $1,350 per ounce level. But the real value that we see in gold is really shown on the next slide, slide 38. In a world where assets are becoming highly correlated with each other, this slide alone shows why gold is so valuable as a diversifier. The middle bars in this chart show how highly correlated U.S. equities are to global indices. And as Lindsay mentioned, the TSX and the S&P 500 are also showing very high correlations. At the same time, you can see that gold is really an uncorrelated asset to nearly all major asset classes. There have been several studies that have shown holding gold in the portfolio will lower volatility and increase your risk-adjusted return. The next slide shows why we think gold could be headed higher. It looks at demand. This is a breakdown of gold demand going back to 2010 and our forecast for 2019. Jewelry demand is the largest one, the blue bar here. It typically accounts for about half of total global demand on an annual basis, and it tends to be relatively stable. The largest markets for gold jewelry are China and India. Private investment demand is also relatively stable. These come in the form of bars and coins. The two swing factors, therefore, that really drive the fluctuations in demand are physically backed gold ETFs and central banks. And ETF inflows and outflows, which are physically backed by gold, tend to be the most volatile. You can see that ETF outflows were a drag on demand for gold in 2013 through 2015 as gold prices peaked. They peaked at around $1,900 an ounce and began to fall thereafter. Although ETF demand was weak for most of the year in 2018, we did see strong net inflows in Q4, which helped turn it slightly positive. It eked out just a slight positive or tailwind for gold demand in 2018. And you can see that we expect a pretty meaningful increase in ETF demand in 2019. Central banks typically are net buyers of gold as central banks look to diversify reserve holdings. It's interesting, on a rolling 12-month basis, central banks' gold buying is at a record level, around just over 700 metric tons. And so you can see that we expect demand for gold in 2019 to be up around 8%, and we're forecasting the average gold price in 2019 to be about 6% above 2018 levels, 2018 average. So now that we've talked about demand, you're probably wondering about gold supply. So we can look at that on the next slide. So I like this slide since it really shows the finite supply of gold. And since gold is virtually indestructible, every ounce that has been mined in the history of time is still around in one form or another. About 50% is jewelry, and the rest is held as private investment in the form of coins and bars. The best estimate suggests around 190,000 metric tons of gold have been mined throughout history. And this may sound like a lot, but it really isn't. If every single ounce was put together, the resulting cube would only measure around 21 meters on each side. And each year, global mining adds approximately 2,500 to 3,000 metric tons to the overall above ground stock of gold. And while gold production really has been increasing in recent years, we think it's going to level off and possibly peak and start to decline. Extracting gold is neither easy nor cheap. At average ore grades, it takes about 20 metric tons of ore to yield just 1 ounce of gold. In terms of cost, this can equate to full cycle costs, which is known as all-in sustaining costs of around $900 per ounce average for the industry. Now, you may have noticed that the supply here at 2,500 to 3,000 falls well short of the demand of 4,500 metric tons a year, and gold recycling accounts for the difference. Recycling has accounted for 30% of total gold supply over the past 20 years, and the majority of that, 90% of gold recycling, actually comes from jewelry, 10% from industrial recycling. So it's true, a finite supply of gold increases its appeal as an investment, but for a gold miner, it's becoming increasingly difficult to continue to grow production and replace reserves each year. On the next slide, you're going to see the various vehicles that investors can look to gain exposure to gold. You can physically buy gold, which would require you to store it in a safe location. The most popular option is a gold ETF that tracks the price performance and eliminates the cost of storage. Gold miners have historically underperformed the bullion price and are clearly more volatile as well. The reason is mostly because the mining industry in the past has made some value-destructive acquisitions at the peak of price cycles, leveraging up their balance sheet. And so, they've really been punished during market troughs because of that. However, global miners have really improved their balance sheets today, and what we've seen from recent M&A is that they've been done at market multiples rather than the large premiums we saw in years past, and they've been funded mostly with equity and not debt. Having said that, there still is a varying degree of operating and financial leverage within gold miners, and it's still the best way to gain the leverage to gold price movements, while an ETF is going to be the safest way to play gold. So now let's look at our Canadian gold coverage on the next slide. Agnico Eagle is our top pick in the space with the 5-star strong buy recommendation. We think the company has the best-in-class risk profile, as most of the company's reserves are in favorable mining jurisdictions, which is very important to the risk profile going forward. The company's ore grade is also best in class at 2.7 grams per ton, and it has one of the strongest production growth profiles. Agnico Eagle is exiting a long period of peak capital spending and is poised to start harvesting free cash flow in our view. We also like Barrick Gold. It has significant scale, and we think there are several upcoming catalysts, the most important of which is a Nevada JV with Newmont Goldcorp, where they're combining their Nevada operations. We see the synergy potential there to be quite large. Kinross is our favorite value play in the space. Kinross has paid down a significant amount of its debt, and in recent years, we think that the free cash flow profile is going to turn around. So now we've looked at precious metals. Let's take a look at industrial metals on the next slide. On this chart, we've plotted the 4 most important industrial metals. Steel and aluminum are on the left axis, and copper and zinc on the right axis. You can really see the strong run-up in prices that happened between 2015 through the summer of 2018. However, what's happened is a trade war between the U.S. and China has led to a great level of uncertainty, and this is never good for industrial metals, a very cyclical industry. You can see just how big of an impact it's had on the trajectory of prices. We had been extremely bullish on industrial metals for the past few years and remained so until recently. Although we do think that eventually a trade deal between the U.S. and China materializes, the uncertainty of timing and how much damage could be done in the meantime has really forced us to throw in the towel on our bullish long-term call here. And on the next slide, you can see why we still have a long-term bullish outlook on copper, despite a more neutral stance in the near term. You know, from our perspective, the long-term fundamentals for copper are very strong. Rising copper intensity globally is a major secular growth story in our view. Electric vehicles consume 3 to 5 times as much copper as an internal combustion car. And there's a significant demand that will come from related investments in charging infrastructure and the power grid. And looking at the supply side of the equation, there's a lack of new mines to really fill this demand. Our scenario analysis shows that the estimated shortfall of copper in 3 different growth scenarios, it just really highlights how tight the global copper market is. Despite our long-term bull call on copper, however, China still remains the major key to the market. China consumes over 50% of the world's copper each year, and although China's economy is slowing, economic data there continues to point to increasing requirement for copper as copper intensity continues to increase. Now on the next slide, we can see that the copper warehouse stocks have been quite low relative to historical levels. The dotted black line mark the seasonal peaks and troughs in copper stocks at trading houses. And this year's seasonal build in inventory, you know, it was well below previous years. And if you look at copper inventory on a days consumption basis, inventory is at historical lows. So we were experiencing a very strong, fundamentally driven price rally in copper until the U.S.-China trade war escalated. And you can see that after that, copper's really been stuck in this weak trading band for the last 9 months. And the reason is clear. You know, you have 1 in 4 of the Chinese goods that would be affected by the new 25% tariff are electrical machinery and equipment. Now let's look at steel and aluminum on slide 46. Following the Section 232 tariffs, the domestic steel capacity in the United States increased from the low 70s to above 80%, which was the stated goal. And the reason why Section 232 worked is that there were tariffs or quotas on every country, including important trading partners, Canada and Mexico. And this prevented transshipping, whereby steel importers would ship first to another country before it would eventually land in the U.S. As a result of better fundamentals, major U.S. capacity expansions were announced at Nucor and Steel Dynamics earlier this year. But a lot has changed since then. Steel prices have been very weak, and you've seen last month the Trump administration has shown some willingness to relax the Section 232 tariffs. So we think this could quickly lead to the U.S. steel market once again being flooded by cheap imports, and this really lowers the fundamental outlook for steel. And just yesterday, U.S. Steel announced that they're shuttering capacity at 3 blast furnaces, 2 in the U.S. and 1 in Europe. You know, overcapacity for both steel and aluminum globally remains a major concern, and so we have a more neutral stance on industrial metals versus precious metals. So let's go ahead and look at there's Teck Resources on the next slide, as well as First Quantum Materials, or First Quantum Minerals. And really we have a strong buy recommendation on Teck Resources. And the reason why we like Teck is that it has nearly equal exposure to 3 commodities: coking coal, copper, and zinc. However, we see them more than doubling their copper production with an important project in Chile. It's called QB2, and that's going to double the production that they have of copper. They also have a minority stake in Suncor's Fort Hills oil sands project. So with an excellent balance sheet and a conservative management team, Teck is actually one of the only companies, major mining companies, that did not raise equity or completely suspend its dividend during the last commodity bear market. At this point, I'll turn the call over to give instructions for the Q&A.
Thanks, Matt. And once again, for everyone, you can submit questions using the GoToWebinar panel. One that has come in, Lindsay, is are there some ways to broadly invest in Canada?
Yeah, there are. And what our colleague Todd Rosenbluth, who heads up our ETF and fund research business would say is to look at an ETF focused on the region. And one that we recommend investors consider looking at is the JP Morgan Beta Builders Canada with the ticker BBCA. It's a relatively new ETF. It was launched in August of 2018. It has $3.4 billion in assets. CFRA finds the stocks inside to be attractively valued, and we think the ETF trades with a tight, it trades with a tight bid-ask spread, and the expense ratio is a modest 19 basis points.
Okay. So Stu and Matt, today at the White House, President Trudeau and President Trump, a lot perhaps in terms of, again, trade or China. Matt, you mentioned Section 232, but any additional insights into this, given it's in the news?
Yeah, Ken, on the energy side at least, the relationship on oil between Canada and U.S. is important in both directions. So both Trudeau and Trump have a pretty strong interest, in my opinion, to get this worked out. Canada needs the U.S. a little bit more than the other way around, but they're both important. Canada sends virtually all of its exports to the U.S., and the U.S., in terms of how much it imports, even though overall imports to the U.S. are down about a third from where they were 10 years ago, Canada's level of exports to the U.S. from the U.S. perspective is up about double in the last 10 years. So right now, Canada is the single largest exporter to the U.S. of crude oil. And the reason for that is it's got that heavy oil product that most of these refineries really do need. So I think the fact that the Canadian government has given the green light for Trans Mountain Express it's not going to get it done overnight, but I think it's a step in the right direction from Trump's perspective. So I think you're going to see more sort of collaborative politics between the two parties.
Okay.
Yeah, and to talk about industrial metals, I think that the Section 232 tariffs on aluminum steel came before the broader set of tariffs that were applied to China and other countries. And I think that those are really targeted at addressing the overcapacity in the global steel and aluminum market. Most of it is in China. At least 50% of global capacity resides in China, and they are the major problem when it comes to dumping cheap products. And so the problem has been in the past that countervailing duties have been circumvented by transshipping, so shipping to other countries first. So Section 232, in our view, was really bullish for steel, not so much for aluminum, but mostly for steel. And so what's happened more recently is that removing those tariffs on Canada and Mexico without at the same time applying some sort of quota system, it puts the industry at risk that all of a sudden, right when they're ready to invest in new state-of-the-art steel mills, you're situated in a point where now you have oversupply and you have the potential for more steel imports entering the country.
Okay. Matt, staying with you, kind of a macro call on gold prices, and as it relates to recently, the upside from here, given that sometimes gold is viewed to be an alternative to equities or when there's issues with currencies or governments. What's your thinking?
Yeah, I think that, what we've seen in the last 2 days in particular really highlights the value of gold and really, its status as a safe haven. You saw that the Fed came out dovish as expected, and that's going to be bullish for gold prices. It's had a pretty impressive run in the last week, and I think that we're trading, like I said, near 6-year highs. We do still think that there's going to be increased demand and more upside to gold. There's a lot of things going well for gold prices to go higher. We haven't addressed yet the government debt, and that's going to become a major issue. We think that especially this will be an issue as we enter the next global recession. And so we still think gold is going to be the go-to safe haven in our view. There are other things that compete with it, and we think that gold is going to continue to be a go-to there.
I would just add to that gold has historically been the best performing asset in any given recession. So it's a good protection to downside in the event that you think uncertainties are going to rise.
Okay. And that would be no matter what inflation is, point of this recession.
Right.
Stu, every week we see production numbers going down in Venezuela. It's heavy oil. In other presentations you've made, you talked about the refiners in the U.S., mostly more heavy oil bent. So what does that mean for heavy oil prices, particularly for Canadian producers?
Yeah, Ken, it's a good question. So Venezuela, as you alluded to, it's kind of on a slow bleed to zero. Today they're producing around 830,000 barrels a day, but the outlook for Venezuela is very poor. So since they produce a heavy oil similar to Canada, that means that, you know, down the road, the number of heavy oil barrels coming into the market from outside of Canada should be lower. Mexico's running into problems as well. So I think in general, qualitatively, that's a plus for Canada. My concern is that the amount of heavy oil barrels that are going to get displaced by IMO 2020 is still going to be in excess of whatever losses Venezuela and Mexico are going to be cooking up. And so I think, you know, if I had to argue which direction I think heavy oil prices are going, I still think that differential is going to get wider, maybe just not quite as wide as if, you know, Venezuela still had a healthy oil industry.
So a call on Canadian oil prices seems to be a call on Alberta, and there's been some views in terms of production curtailments. So as we look ahead to 2020, what could this mean?
So the last time, the curtailments that you're referring to took place in 2018. That was at a time when the differentials were at an unprecedented level of around $45 to $50 a barrel. I don't think the differential is going to get that wide to encourage more curtailments. So I don't expect that to happen, although I do expect that we could easily see a differential that today is in the low double-digit range, could maybe approach $20 a barrel by the end of the year.
Matt, in your presentation, you spoke about the precious metals industry being a global business, and we've certainly seen a lot of M&A activity in gold mining industry. Where can it be looking ahead? Are we done? Are governments like Canada going to be protective, or it's just going to continue?
Yeah, that's a great question. Actually, at the end of 2018 and early 2019, we saw two very large deals. Barrick bought Randgold and Newmont acquired Goldcorp, really creating two gold giants. As I mentioned during the presentation, you know, larger gold producers are really facing the challenge of continuing to grow and to find new reserves. It's arguably cheaper to acquire reserves than to explore for new deposits. And so that's one of the biggest reasons why we think, you know, what we've seen in terms of this surge of M&A in the space is likely to continue. And what is also important to point out is that these two companies that have come together are going to have non-core assets, mines that they deem that don't fit within their core of their asset base. So there's going to be a lot of divestitures, and so we think that there's going to be the opportunities for smaller to intermediate miners to pick up attractive assets from these companies, and really the whole mining industry, gold mining industry, is going to benefit because of this.
Great. This will be a quick go around for everyone, and the question that came in is, what are your thoughts on the upcoming Canadian election and its impact on the TSX in 2020?
Yeah, I mean, I think they'll definitely, I'll just quickly start. I think there will be an impact, as there is in any market when there's a major election like that. And of course, especially, I think oil is going to be one of the major policy issues that are going to have to be addressed in the run-up to the election. So there could be some volatility around that, and probably an impact to prices. I don't know what Stuart thinks.
Yeah, I think there's not a lot of time left before the election. I think Trudeau's decision to greenlight Trans Mountain expansion probably costs him BC, because BC is simply not in favor of those kinds of projects.
Columbia, right?
Yes.
Okay.
Good point. You know, I think if they lose, if Trudeau's government loses this election, it's probably going to be to the Conservatives. And if anything, the Conservative Party probably ushers in more oil and gas development than Trudeau would. So the net effect from the political issue on oil and gas is maybe neutral to slightly positive.
Matt?
Yeah, I think that from a material standpoint, you know, the gold in particular doesn't face the differential problem that oil does. And I think that, you know, just to add to the comments that have already been made, the most important thing there is central banks and the Fed in particular. So a weak U.S. dollar is going to continue to be very, if that continues, is going to be positive for this sector. So we'll have to watch the trajectory of the dollar.
Awesome. So in closing remarks, today's session has been recorded, and a link to the recording will be made available within the next few business days. I want to thank Lindsay, Stu, and Matt for a great job. And on behalf of the team at CFRA, we'd like to thank you for joining us today. For those of you who subscribe to our MarketScope Advisor platform, you'll be able to find many of the research notes and analysis on the topics and companies we covered today, the industry surveys, and much more. If you're interested in learning more about MarketScope Advisor, please visit our website, www.cfraresearch.com, to request the trial. Should you have any other questions, please don't hesitate to reach us at cservices@cfraresearch.com. Again, thank you and have a great day.